Hello Deep Value community, welcome. Today's video is about what you need to know before investing in a business. If you're new to the channel, please subscribe so you can get my next video installment as we go along our value investing journey together. So let's get started. Before investing in a business, the case I've used here today is Apple, just because it's a business everyone is very familiar with, but it could have easily picked out a different business. But if I was just starting off, I would go on Morningstar, I would look up on key ratios, and I would go to full key ratios. This would just give me a 10-year plan, quick and dirty, of how the business is performing over the past 10 years. Now, there are many expensive packages. I do not recommend using any of them. I recommend that you do the hard work yourself or going through these filings. But I hope that as I go through this and I simplify the process, I hope that you'll think, okay, this is something that I can do. It's really quick and easy, X, Y, Z, before you invest. Okay? Come on to the SEC website. This is the website. Type in the ticker here. These are some of the forms that you're going to need. The 13D is a personal favorite of mine. 13D, if you think of it from a management perspective, it's like dope. So it's like the 13D means that it's often an activist shareholder, not always, but often an activist shareholder getting involved in the business trying to shake up things. Now, in my perspective, because I invest in deep value stocks, if someone is coming in and taking a large position in the stock and trying to shake up management, I believe that's quite beneficial for you as a shareholder. Remember, you as a shareholder and your interests are not always, sometimes they are, but not always aligned with management. Management's interest is to manage the business. Some managements think as shareholders and they are very shareholder friendly. That's not always the case. So 13D is one of my personal filings that I like. 13G means kind of 13 good. It's kind of like management thinks, oh, that's good. It's just a passive investment. So 13D is one that I like. 10K is the example I'm going to use in this video. 10Q is the quarterly. Quarterly is quite short and there's not a lot of detail there. The 8K is something that is in between the earnings. So that's quite a useful one if something's shaking up the business inside. The proxy is the DEF 14A. There's another one that gets posted at the same time pretty much and has an extra A here. Do not necessarily go for that. That's just a bit of boilerplate. This one is the one that matters, and this tells you how much does management own. This tells you a lot about the management and tells you a lot about who else owns the stock apart from you. This gets published once a year, approximately the same time as 10K. This one is one that you need to be worried about. If you see an S3 filing, it means that they're putting a shelf filing. That may mean, not always, that may mean that they're going to resort to capital markets. Sometimes, but not always, they're going to be diluting the shareholder. This is one that I'm quite fearful of if I'm investing in a business that is a deep value business, a business that is kind of going for a difficult patch and they file an S3, it may mean that they're going to dilute the shareholder. This is something that I'm concerned about. The Form 3 is when the insider management is going to do the first buy in the open market of their company. So it's a new director and they're going to or a new CEO, they're going to come in and they're going to file a Form 3. A Form 4 is just the insider is going to buy or sell stock in the company. I find it quite helpful to go on Insider Cow. There's no adverts. It's a no-frills website, Insider Cow, and it just basically tells you quick and dirty who else is buying the stock. I like that website, so you may also. So let's move on. This is the order that I look at businesses. So I come first and foremost to the financial statements. I then look at the risk factors. And I then look at management's rhetoric. Many shareholders start by trying to understand the rhetoric around the company, but I believe the best thing you need to do is come straight to the financial statements and get dug in. just as a quick separate thing, I look at short squeeze because I want to try and find out, just very quickly, how shorted is a stock. I like stocks that are heavily shorted. It's not a prerequisite for me, but I do like to see, is it highly shorted? Now, often, but not always, the stock is highly shorted for a particular reason. Okay, so don't be a hero. Don't go into something that is highly shorted and think, oh, the shorts have overstayed their welcome and therefore there is a lot of value in the stock. Not necessarily, but I do like to see how significantly short it are. If the company is shorted, let's say 2 or 3%, that's nothing. Like, it's just, run of the mill. But if the company is shorted north of 15%, that could be quite something that's quite interesting, because the short, at some points, they're obliged to buy up their position back. So if the company starts to improve their fundamentals, they'll be forced to buy up the shares of your company. So that they're forced buyer. So that could be something, because at some point they have to buy back. So that's something that's quite interesting to me. So the balance sheet. So one of the comments from Evidence Hub, one of the commentators said that I'd gone through balance sheets too quickly on the last time. So I hope that today's video I'm going to go through slower but in detail, and I hope that this is more useful. So please let me know in the comments below if I need to go even slower through this, but I think I've got it right this time. So go onto the balance sheet. We know the business Apple. It's a service business, kind of, more or less. So it does have a lot of cash, but try straight up, go and figure out your business. How much cash does it have? And look at the total current assets. Then you look at the total current liabilities. In the case of Apple, it's a very well managed business. So the current liabilities are liabilities that need to be paid out over the next 12 months. There are some exclusions to this, but if you just think, okay, this is something that has to be covered in the next year. Now, a well-managed business has total current assets just slightly more or approximately the same as total current liabilities. You do not want to be invested in a business that the liabilities are significantly more, the total current liabilities are significantly more than the total current assets. Okay? So you don't want to be invested in the same way in a business that has a lot of current assets and has only a little bit of current liabilities. That may mean the business is not very well being managed very well. So why would the business have too much in current assets? It could be the business has a lot of inventory on its balance sheet that is not able to be sold off. Think of a retailer. Think of a business that's kind of selling something or a product that is no longer that useful. So let's move on. In the case of Apple, its non-current liabilities is very clean. It's just practically debt. Other businesses, you may have pensions, you may have some nasty things here, so just go through that. But in this example, in this video, I just wanted to kind of go through as quickly as possible the things to look at on the debt side. So in the case of Apple, you just go on to type in Control F on the filing, look at contractual obligations. So in the case of Apple, you can see that there's nothing really in the next couple of years in terms of debts that is upcoming. But you just look through that. It's like a quick and easy thing you can do. In the case of Apple, you can see that their maturities extend out until 2049. So it's really long-term dated debt. That's just really excellent. Type in Control F and go to try and figure out what is the interest rate. So Apple is AAA rated, so the interest rate on most of its debt averages out as 2.2%. So just try and figure out if at this present time the bulk of the debt is, let's say, north of 7%, then that tells you straight away that the creditors believe that your business is high risk. That's why they demand such a high interest on the debt. So if the creditors typically think that the business is high risk, there's more likely than not a reason for that, and I would try not to invest in that business. It's important to be selective in the businesses that you invest. Moving on. So in the case of Apple, it's a service business. Just quickly look at selected financial data and you can see that in the case of Apple, that the assets are not really growing significantly over the last several years. So Apple's cash has hovered around 200 billion, and I know that the debt has come up slightly from 53 billion to 91, but for all intents and purposes, the assets of Apple have not really changed because Apple is growing its business and is buying back shares. So over time, on the balance sheet, the equity is shrinking, and that's great. It means that the business is returning a large amount of capital to shareholder. So that's a really good thing to think about. Next, look at the risk factors. You don't need to look at every single risk factor, just look at the top 3 or 4. It takes you a few minutes, just go through the top 3 or 4 risks facing the business. You'll get a really good grasp of what you need to look out for. Next, I'll go to the cash flow statement, and hopefully on the next video you can see the cash flow statement. And as always, I hope you found that useful. Drop comments and please subscribe. See you next time.